Good morning, we're Team B, and we're trying to explain what is private credit today. Our group includes me, Simon, George, Arav, and Henry. And we're trying our best to explain how private credit works, why does it exist in the market, and how does it work in terms of basically what's the implication. So let's start off how this basically lending works. So lending originally is based on usually a bank. So where does the money came from is the banks receive money from normal people, for example, individuals who has money, wealthy conglomerates, businesses, everything. And these are usually called deposits. So banks, they will have a lot of deposits placing in the banks, and it was protected by the central bank. And all of these money into the bank are then going to be lended back out based on the ratio set at the bank. It needs to be secured, which is called the minimum lending ratio, everything. And these money will be placed into lending, and with a fee, of course. Usually 80% of the loans are distributed back into the market and lending it back out of the market, and these are usually called a line of credit. So the loans usually they would be distributed into two ways. First is through commercially, basically credit cards, bills that you need to pay. For example, basic simple equities that you're gonna buy would be using credit. There's usually commercial use, mainly it's credit card. And as for the second one is usually corporate. Corporate usually have normal term loans, syndicated loans, which is towards multinationals and conglomerates. And these usually has around 5 to at most 15% of percentage of loan. And usually corporate syndicated loans are very secure. Usually these conglomerates has high credit rating, a very healthy cash flow, and usually have a good reputation in terms of their company. So usually banks would more inclined to give out commercial and also corporate loans to people, and that's how lending works in usual context. So now moving on. So what is private credit? So maybe you would say private is basically not the normal market, and credit is basically lending money to you. So basically you get a fee, is the same thing, it's just not publicly, not for a bank. So it's similar. So private credit is actually something understanding. So usually it's insurers, normal banks would provide money as well. And also a huge portion of money come from pension funds as well. And these usually are funds that people would be allocated into private credit, and also distributed to companies that are less reputable, but with much more need for having line of credit. So why does private credit work? So because during recessions, people would be banks would be more worried not to give out much loans, because they are worried about the implications, and the interest rate is going to be fluctuating. And for private credit, it has a floating interest rate, and also it can lend to much more SMEs with higher interest rates. And usually as it is private, it is dealing with the companies itself. Usually it will have lower volatility, but with higher risk, but as well as higher return. So as I just mentioned, why private credit? Why does people want to use private credit? So the first thing we need to understand is about risks and volatility. Risk is actually defined as the possibility asset will lose value. So basically, if the asset is going to lose value in the future, it depreciates, is called risk. It loses all value, it broken down, is called risk. As for volatility, it is the likelihood that having a sudden change in terms of price. For example, stocks, like you can see Tesla going up very high, and suddenly it will go very low due to political different implications, and that's called volatility. And in the historical returns chart, we can see that private credit usually has really, really high annualized returns, but with very low annualized volatility. And you might wonder, why is it low on volatility? As you can see, a lot of higher yield products, for example, stocks, equity, leverage loans from banks, investment grade bonds as well, treasuries as well. These are usually very according to the market. For example, treasuries and investment grade bonds is highly correlated with the interest rate imposed by the U.S. Federal Reserve. And as for private credit, as you can know, the private word, it is dealing with companies that may not be on maybe not even a blue chip stock. It's not even on listed company. Maybe it's SMEs, startups, or even angel investors, conglomerates, or maybe private equity as well. So as the company is private, it has less. Their valuation is based on what their company is doing instead of what the stock price is. So as a result, the volatility is relatively low, but it has higher risk in terms of you may not get the returns, or maybe that company goes to bust or close down. As for example, high yield stocks and for leveraged loans and investment grade bonds, these has really backed by the government and backed by very reputable firms. Though despite having high volatility, it has very low risk and consistent returns. That's what people are trying to do, and that's why type of credits exist. So now let's take a look of what types of private credit there is. So the first type we'll have is very common. It is direct lending. So it's very simple. It's basically lending loans directly to business or borrowers. It's the same thing as what banks does, but it is completely different because you're dealing with the different clients. So private firms, you deal with SMEs, but like for big banks, you deal with reputable, high cash flow companies, for example, like Sanhong Kai or like Swire Group, or for example, Nike, those kind of people. Second is distressed debt. So investing in debt for financially troubled companies, for example, like real estate companies and small and medium-sized companies in, for example, LA, Texas, in which there are a lot of building projects and everywhere. They're not really conglomerate infrastructure builder, but they have very high in debt as well, because their companies is higher on capital. No matter they are really subjected to the market situation, and they think they can do a better job in the future, and that's why they ask for some private credit firms for a distressed debt, and usually this is one of the products. And the third kind is about a mezzanine credit. So it's a hybrid version of debt and equity financing. So you would give out some of the shares to the people as a form of financing or so-called collateral, and typically for expansion of established companies. So why do you need a mezzanine credit? So first of all, you need debt. You need to ensure the company is able to repay the private credit firm. As in terms of debt, you have the high interest as usual. But for equity financing, is also prioritizing new owners. So as our private credit firms, they will be looking at the company's performance closely and thinking about the possibility of owning or merging with this company. As for established companies, when they're going for expansion, they're going to dislocate from their mother company from their mother company, or they're seeking to be selling to some other firms as well. So as for mezzanine credit, it is used to prioritize new owners and to protect new owners from, for example, senior creditors, which usually gets paid the first. As for the loan types in credit, you can see secured loan, which is usually direct lending, and mezzanine, which is mezzanine credit. You can see majority of the loan types are in secured loans. And as for geographical focus of private credit funds, you can see North America consists of 63.5%, and Europe 26.5%, and Asia 6.6%, and other emerging markets are relatively lower. So you can see the SME businesses, the private credit funds would usually provide private credit loans to people who are through countries that are more established with better business environment as well. So in the private credit market, the major players includes, first of all, Ares Management, and the second is KKR, which some people might have heard of, and the third is Apollo Management, Global Management, and Oaktree Capital Management as well. And the highest builder is Blackstone. And Oaktree, is former GBUS people, who is one of the USC alumni for the CEO, I think, which has a very good fireside chat just a while ago. And for Oaktree Capital is around US 4.4 billion asset under management just for private credit, and the market leader is definitely Blackstone with 58.1 billion US dollars asset under management for this private credit firm.